Hello, everybody. Welcome to the latest session of today's ESG Show Summit. Joined today with some absolutely amazing guests. And I would like to kick off pretty much straight away, don't want to mess around, with some questions. And I'm going to ask each of the guests to introduce themselves as they answer the questions. And I want to kick off with Bill Davis, if I can find you, Bill. Hello, Bill. Could you quickly just 30 seconds, or less than that, just quickly say who you are and just introduce yourself?
Yeah, sure. Bill Davis, founder, portfolio manager at Stance Capital, based out of Boston. We're a asset management shop purpose-built around values-aligned investing, and really kind of dedicated to the idea that investors in non-ESG investors have access to all kinds of interesting product across multiple asset classes. And we're very dedicated to the idea that if you care about values, you should actually have access to the same quality product. So that's a bit about us, and good to be here.
Well, great to have you here. And you ask you a question straight away. Is ESG anti-profit? So, why do ESG investing if it's anti-profit, or maybe it isn't?
No, I think the answer to that is a little bit complex, and it depends on the company and the industry and the time horizon. But, look, companies that have strong ESG profiles are good at cutting costs as a result, reducing waste, improving employee retention, lowering the cost of capital, generally speaking, putting more profit on the bottom line. And so I think it's very hard to argue with any of that. I mean, I think that, the counter argument is probably, in order to initiate all of these endeavors, it costs money that otherwise could be returned to shareholders. But that's kind of like the American short-sighted, view of the world. It's all about like, what are you doing for me this quarter? But ultimately, I think the job of a corporation is to deliver long-term shareholder value. And I don't think that can be achieved unless you've got actually a pretty robust environmental governance and, community-focused operation.
Thank you for that, Bill. Matthew, Mr. Sequel, how are you today? Could you just swiftly introduce yourself?
Sure. Hey, folks, my name is Matt Sequel. I'm a Sustainability Global Black Belt at Microsoft. I'm here on my own accord today to give, as Michael knows, my opinion on a whole bunch of things. I wrote a book called ESG Mindset. I'm an advisor at Enzo Advisors, and I also sit on the LP Advisory Committee of Morgan Stanley's Next Level Fund. So a lot of things.
Okay, Matthew, I thought I'd ask you a proper hot and cold question. I'm going to say ESG investing, hot or cold?
Well, it depends on what you mean, but I think it's hot, and I think it's starting to come around again. I think there's been a lot of conflation over the last couple of years between ESG and sustainable investing, which I don't think are the same things. But I do think ESG investing is starting to come around, so I'd say hot.
Okay, thank you for that. And now let's bring on, and I'm going to apologize in advance because I know I catch your name wrong, aren't I? Lycia. I'm so sorry. If you appear on the show 3 times, I'll get it right by the end. Lycia. Similar question to you then. Pensions for purpose. Oh, perhaps you could just introduce yourself first.
Yeah, absolutely. So I'm Lycia. I'm a director at Pensions for Purpose. We're a membership organisation based in the UK with the goal of getting pensions capital invested in a way that supports people and the planet. Okay, and same question that I asked to Matthew. ESG investing, hot or cold? Cold for me. I agree with what Matthew said, that ESG investing and sustainable investing are different things. But for me, ESG investing is just investing. Part of any type of investment management involves considering all your risks and opportunities. Some of those risks and opportunities are environmental, social, and governance related in nature. Bringing those out and separating them from all the other types of financial risks, I think is more of a marketing strategy than an investment strategy, because it was already meant to be part of any investment process. I think we need to, if we want to address the big sustainability challenges of our time, we need to move towards sustainable, even impact investing.
Okay, so it's sustainable or impact investing is it, not ESG investing.
Yeah, for me, ESG investing, there's been a lack of clarity on what it is. And I think that's one of the reasons there's been backlash. There's lots of reasons for that. But also in terms of how I understand the definition, ESG investing is just investing, and the financial systems we have aren't really designed to be sustainable. So that's why we need to go further than that. All
right. Okay. Thank you for that. Cecilia, can you just quickly introduce yourself?
Yes, hello, Mike. Very nice to be back on the show. So I'm Cecilia. I work as a senior advisor with a firm and a partner in the other, but I also help startup founders and scale-up founders with fundraising, strategic advice, and regulatory affairs.
Okay, and now I'm going to ask you, the backlash, real or hype?
Both, if I dare to say. A part of it is more hype, because the reality is that we still see ESG and ESG investing in a deeper sense. That continues, but of course the political environment has completely changed, and we also see, of course, from Brussels side there is reopening of, for instance, the sustainable finance regulation and other frameworks, and that might very well redefine some of the definitions we are using currently in terms of sustainable finance and ESG investing.
Thank you very much, Cecilia. Chris, Sneha, so sorry, Sneha, I'll be bringing you back in a moment. Chris, I wanted to talk to you about Shakespeare. Shakespeare said, "That which we call a rose by any other name would smell so sweet." That which we call ESG by impact investing or sustainability investing would sound an awful lot better. What are your thoughts? Do we need to change the name, or maybe we don't need to change the name? We just, ESG investing is it's too narrow a topic.
Well, I think there's a number of different elements, some of which have been touched on already. But one of them is simply that the term ESG has been somewhat kind of weaponized by populist politicians, particularly in the US, without having a real kind of understanding of what it really kind of involves, and it's really been very much kind of conflated with some kind of social engineering, when in fact, as I think has been stated by one or two people already, it's very much a matter of, particularly Bill, it's a matter of ensuring that or managing risks in a way that are good for the long-term value of the enterprise and its investors. I think that's an important, that is an important role that investors play in holding to companies to account. I mean, I've got some sympathy for Larcia's perspective that ensuring that companies look after their ESG risks isn't quite the same as ensuring that they are contributing to addressing some of the kind of systemic risks that we're facing as a species, so to speak. But I feel it's very much along a kind of the similar kind of spectrum.
Okay, thank you for that, Chris. Now I am going to bring you on, Sneha, if I can find you. There you are. What about you? Let's go back to the beginning again. The question I asked Bill. ESG investing. Are you cold on ESG investing?
Well, I'll say warm, but not the fix. So sustainable investing or ESG investing, I think if I have to do a comparison, sustainable investing sounds more softer, more intuitive, and less regulatory, less political. And I think, like, honestly, like, changing the name won't fix a weak strategy or poor delivery. So call it what you want, but unless and until you back it up with results, no one's really buying it. So I think it's more like forcing ESG to grow up and prove itself, and that's a good thing, regardless of the name ESG investing or sustainable investing.
And Sneha, I forgot to ask you to introduce yourself. Indeed, I forgot to ask you to introduce yourself.
Yeah, hello, Mike, and and hi, everyone else. I'm Sneha. Very nice to be back on the show. So my career is built around a decade of work experience in the asset management and hedge fund industry in ESG investments and ESG integration in financial models, things like DCF. I'm currently working at a hedge fund in London. It's a quant macro hedge fund. I've worked on Article 8 and 9 funds where the mandate is 100% sustainable investing. And I've worked in thematic investing, etc. So that's me.
Okay, thank you very much. And Paul. Hello, Paul. You've been on on today already, but because not everyone watching this would have watched you earlier, can you just very briefly say who you are?
Hi, Michael. Yeah, thanks. Paul Clements Hunt, coined ESG in 2004 as a UN official. Last 12 years have been running my own company, the Blended Capital Group, advisory, but a focus on first mile communities. So yeah, that's who I am. And I guess I've been in the game of mobilizing capital towards sustainability since my first company in Bangkok in 91.
Okay, and as the man that coined the acronym, what better question to ask you than, do we need to change the name? Should ESG investing be called something else?
No, for God's sake, don't change any more acronyms. We've been doing that for about 40 years. And whenever acronyms run out of marketing juice, the asset management crew get rid of it. So look, ESG was about sensitizing asset owners to the financial materiality and fiduciary duty of risk. It's not sustainable development. It's not sustainability. It was a tool to get the PRI launched in 2006. And no acronym changing. And I think there's massive amounts of confusion. ESG, it changed the conversation. Whether it's GES or SG, the systemic risks are still there, and the massive value to be unlocked for the 21st century is also there. So I'm sort of fairly Jesuit in my opinions on changing acronyms.
Okay, thank you very much. Were you going to add something else?
I'm just going to say, look, the acronym gives indigestion to people like Trump and the rest of the autocrats. So just keep it for a while, as long as it's poking them in the right way. Game on.
Rene's the solution to that, aren't they? Indigestion, I think. It's an easy solution. Thank you, Paul. Please come back shortly. Hello, Bonnie. I can hear you now. Okay. So, Bonnie, I think what we'll do is we'll bypass hot and cold, and I'll have a quick chat with you. And
are you sure you don't want to hear what are you sure you don't want to hear it? What?
No, well, you can cover it. You can cover it within our chat. So, if you could just quickly introduce yourself.
Yes, I'm Bonnie Linda Bartok. I'm the founder of the world's first social performance index, the MSPI, the founder of S Factor, the social factor data company that has built ratings and indexes. And I'm now launching Lioness, which is powered by S Factor, the world's first long-short global equities and social risk arbitrage using social risk data. Okay.
All right. And let's ask you a hot and cold question. What do you think? Do you think we need to change the name, or are you bullish on ESG investing?
I'm bullish. I'm bullish in a big way because I think that it's mispriced risk. And I think there's an insatiable amount of opportunity there to set the bar. And I think really we can teach the market about the opportunity as it relates to that, based on what ESG was meant to be. And I would echo, obviously, everything that Paul just said. So I've been a huge fan since 2009. I just thought the S was a little light, so I've reinvented it in a way. But I'm bullish on ESG, and I've been traveling all over Europe the last couple of weeks marketing, and it's everywhere. People don't know what else to call it.
Okay, so Paul always said the S is put in the middle to stop it from falling. You've got an E and the G either side to stop it falling out. I think you would argue that the S should be bigger. It should be the big book.
I think
big tome in the middle.
Well, I think S is where alpha sits.
All right. What can you just tell me what social risk is?
Yeah, I mean, we've heard it from Paul as to what it was meant to be, but it refers to the potential of financial, reputational, and operational harm a company faces. So it really is about internal controls and risks, about the probability of lost time cost related to issues based on how companies treat people, workers, communities, consumers. It includes things like forced labor, unsafe working conditions, discrimination, land rights violations, unethical supply chains, and so on. That's
okay, so I got a question here. Who cares? But I really think I ought to play the part. So I'm going, oh, who cares? So, you know, who cares about this?
Everybody who's burning, investors, regulators, insurers, and certainly consumers, more so, increasingly so, because poor social performance can lead to lawsuits, brand damage, not brain damage, brand damage, maybe brain damage if we did, yeah. Supply chain disruption, declining shareholder value. It's no longer a moral issue. It is a material issue. And we're about to prove that with Lioness.
Okay, now I'm going to ask you to outline the 10 high-level global statistics for social risk. But we don't really have, I mean, you're just going to have to list them really and give me no more than 5 seconds each. So in fact, you don't necessarily have to do all 10. Can you just give us some of the key social risk?
Investors ask me all the time what I mean, because they think I'm talking about philanthropy and foundations and charity and impact investing and, you know, societal alignment with inclusive capitalism. And actually what we're talking about is modern slavery. We're talking about child labor, forced labor, exploited labor. There's some pretty substantial numbers that I sent you earlier, which I will publish after this recording so that you can have the actual numbers. But the reason it matters from an investment context is the destabilization of supply chain based on these exploited matters. So human rights, land tenure, you know, disproportionate number of women working in the garment factories who are underrepresented, underpaid, exploited, harassed, and so on, can destabilize entire supply chains. So that will roll out, you know, 8 or 9 months later to a portfolio where all the companies are scrambling to cover the controversy and move their supply chains elsewhere and find other suppliers as things come to light. And so that can actually have a substantial disruption.
All right. Okay. So I would have thought one of the big social risk dangers then would be underpaid podcast hosts. Would you agree with that? Or
definitely. I mean, how else would we get information transparency? How else would we know?
Absolutely, absolutely. So what are you doing about all this then? So tell us about your big plan. But I'm so sorry, you're going to have to tell me very quickly. But
yeah, absolutely. Listen, we built a long short global equities strategy, which is long in the global best in class, and really we are shorting preemptive disruptions to the market based on unpriced or mispriced risks, essentially.
Thank you very much.
Yeah, our data is
there is a social risk hedge fund is what you're launching.
Social risk arbitrage is what we're calling it. Yeah.
Oh, arbitrage. Okay, fair enough.
Yeah.
All right.
It's like triage, but different.
Okay, Chris, I forgot to ask you to introduce yourself when I had you on earlier, and I thought now would be a good opportunity to do that before I pull on the guys that you're going to be chatting to. You're on mute, I think, Chris.
Shall I do that as you bring everyone into the studio then, Michael?
Well, everyone's here with the exception of Paul, who's suddenly looking like a wall. But apart from that, oh, here he is. Here he is.
You caught me snoozing.
I'm going to be doing that after this. Everyone else has introduced themselves, but I forgot to ask you to introduce yourself.
Okay, well, I will do that, and I'll thank you, Michael, for inviting me to moderate this first panel discussion. My name's Chris Hall. 5 years ago, I founded a publication called ESG Investor, and I've tracked the rise of ESG investing over that kind of period from 2020 to now. And I recently launched a Substack that you can also read, which is very much focused on the sustainability of the food and agriculture sectors, called Harvest. So if anyone's interested in that topic, please do take a look at.
Well, we need to have a chat then, because we've got one on sustainable agriculture. We've got a show coming up on sustainable agriculture later this month, or I beg your pardon, June.
Okay, well, let's talk about that later. Thanks, Michael, and thanks to the sponsors, Alp Academy, and thanks to everyone for participating in this session. We've got about 25 minutes ahead of a second panel discussion that'll start at around 3, and I know that Bill has to go at 3. For this session, we're really going to focus on 2 themes that are quite socially focused, which is looking at the kind of the just transition, and also looking at DEI as a focus for ESG investors. And if we have time, we might dive into 1 or 2 other themes as well. If not, they'll have to wait until the second panel discussion. So I wanted to kind of start off by asking everyone for their perspective on what is the role of the investment community in supporting and facilitating the just transition. I'll just quickly explain what I mean by just transition, and to a certain extent, Bonnie Lynn kind of preempted it in terms of it. We're really looking at the impact on workers, on consumers, on communities of the whole scale kind of decarbonisation of large parts of the global economy. Now that starts with the energy generation, but it also does include the kind of food and agriculture sector, as probably we all know around 30% of emissions come from that sector. But it's really about the energy transition at first. Making sure that energy transition does not, burden consumers, and that it doesn't displace workers in a way that kind of creates problems for them and for society. So I wanted to, and we're currently at the stage where I think that in different kind of markets, the nature of the kind of decarbonisation efforts are as much a kind of very much an issue for policymakers alongside the companies that are developing the kind of technologies. So I thought perhaps I'd start with you, Paul, if I may, in terms of what your view is on the role of the investment community in supporting and facilitating the just transition.
Before you answer, Paul, can I just ask, because we're getting a little background noise, no idea where it's coming from, but if you're not talking, would you mind putting your microphone on mic? I don't know who it's coming from, but there is background noise. Sorry, I'm going.
Okay, good, Chris. Great question. Can you hear me okay?
Absolutely.
All right. Look, just at an absolute macro context, the role of investment in the financial systems in terms of creating a political economy that works in terms of energy are massive. But we're talking about a century exercise. The idea that we can suddenly turn off the least developed countries, the middle income, lower middle income countries to fossil fuels, whether it's coal or oil, is, for me, is just, it's actually nonsense and has been for a long time. It's the claymore at the middle of the UN climate change process, which existed since the 90s, the early 90s when it started. But to answer your question, I think on the positive side, look, we're going to see the market move right now. And if you look at the International Swaps and Derivatives Association, they're finally beginning to focus on it. We'll see the market move from carbon offsets, voluntary markets, which have been necessary but are not credible, to tradable carbon securities. There are structures which are already passing the Howey test in the US in terms of those 4 tests of what is a security. Once those securities become an asset on the balance sheet rather than liability, that will change the markets. And I think we'll see that extend into nature-based solutions and tradable securities. Won't happen overnight, but it's happening now. The biggest players are beginning to look at it, and they're beginning to understand that in terms of the energy transition, you're going to make more money out of saving the planet than you are out of screwing the planet. And I think that's a huge shift that will happen in the next 5-10 years. So the move from carbon offsets, nature-based solutions, to tradable carbon securities, which can be issued either at the sovereign level, the sub-sovereign level. Within that, and I'll leave it here because I know there's not much time, a lot of people on, a lot of very experienced people. The financial system has to be more creative in terms of the products and the structures and the platforms and the investability into the dignified transition. I think it's a gold mine waiting to happen. There's a lot of timidity in terms of capital. There's a lot of laziness. There's some outliers, most of them on the platform here. But it's that idea of how do you structure, how do you create new instruments which actually persuade capital to come in at scale and take the market from hundreds of billions, maybe a few trillions, to a market which actually transforms the way we use energy. Final point. Yeah, look, nuclear is part of it. Mini nuclear is going to be part of the decarbonization. Fossil fuels will be around for quite a long time. Tell India or Indonesia to switch off from coal, or China. Not going to happen. We have to be far more creative as a financial system, and the upside to unlock value is huge. Sorry if that's a bit rushed, but I'm very cognizant of the great minds around here. But watch that space. ISDA finally created a climate group in March 2024. So they were set up in 1984. Once the International Swaps and Derivatives Association get to grips with climate change, that changes the market.
Okay, well, thanks, Paul. I mean, there you're talking about innovative instruments that help to support the transition, and of course, those nature-based solutions and carbon offsets. They've had a mixed history, partly because they haven't actually delivered on the
Chris,
on the
that's it. Chris,
to
jump in. I wasn't saying carbon offsets. I wasn't saying nature-based solutions. It's the shift to tradable securities in the context of planetary. It's totally different. That's what will transform the market. So I don't want to make a confusion there. I'm not defending those solutions. The financial system itself has to generate the new products which are investable.
Yeah. Okay. The point I'm trying to get onto is that past some of the ways in which finance has been kind of directed towards environmentally positive and transitional projects hasn't necessarily been in the past. They haven't had sufficient kind of social kind of safeguards. That was really the kind of point I was trying to make. Bonnie Lynn, what's kind of your take on how investors are, the extent to which investors are aware of the kind of social angle on the kind of energy transition? You're on mute, I think, Bonnie.
Oh, it was the best part. So, I sat on a panel at G20 in India in 2023, and the panel was how to mobilize big capital to social issues the way we've done for environment. And the reality is that markets follow returns. So, my take is we need to get smarter about non-financial material events, quantifying them in such ways that you make them tradable, right? So pricing in mispriced or underpriced risk to the market is a huge opportunity. So if our fund will be classified SFDR Article 8. Well, they're all long only. So I'm beating them by 15% in my track. So I'm hoping to disrupt that market a little bit, whereby they start doing the same thing creatively with different data sets. That's how you move the market. That's how you move the needle. The biggest resistance from the market is, I don't think policy and overregulation, it's performance. There was a rush in, no performance, and a rush out, and then, a squabble over voluntary versus regulatory and so on. And the reality is we need to be smarter about beating the market with it. And exactly, I would echo, I think Paul just said this, we need to beat the market and the money will follow. It won't be as much about the definition as it will be about the performance.
Okay, so it seems that we're looking for new solutions. We're looking for new instruments, Bill. But in addition to that, there's clearly those kind of existing investments that asset owners have in their portfolios when it comes to engaging and driving on the kind of energy transition and making sure that that transition has a kind of just element for the consumers and the workers. How should investors balance those responsibilities?
First of all, investors need to continue to do what they have been doing. And in fact, they need to probably accelerate it, which is to engage with companies and help them understand the importance of these issues. And, there's a lot of collaborative frameworks that have been set up. Climate Action 100 is a great example of one. Unfortunately, I think investors have done the same thing that corporations have done, which is that they have bowed to political pressure. Some investors have dropped out. Interestingly, for all the US-based investors that have dropped out of Climate Action 100, they have been replaced 1.3 times over by European and non-US investors who are basically leaning into the same corporations. So I think, that's part of my answer. The other part of my answer is that from a US perspective, transition risk has gone down because there's a lot less transition that's happening. Unfortunately, like offshore wind has basically entirely stopped in the US at this point. And while that happens, though, physical risk goes up. And so ultimately, I think the job of investors is to push on both of these issues. I am a little bit heartened because I've spent a lot of time down in Houston, Texas in the last couple of years. And I do think that there is actually at a project level, right? When there is, say, for example, what's happening in the with hydrogen in the Houston economy, I think that there is a real sensitivity by corporations to transition risk and supporting impacted communities during the process. I think, and so it's easy for me to kind of as an investor who's in public markets, it's easier for me to envision transition risk being better managed at a project level, at an individual development level. It gets harder when you're analyzing a company that's doing a lot of things everywhere and they're less transparent around it, right? So I think part of the challenge as an investor in public markets is to really figure out kind of what is sort of talk from companies versus action. And ironically, I think in some ways, Trump actually helps transparency because he's exposed corporations who don't have the spine to stand up to him. And unfortunately, there's far too many of them right now.
Yeah.
Well, it's interesting to note that just picking up on your point about wind, Bill, I noticed that Equinor has actually been given the green light to get going on its wind project just off the New York coast. And so there is at least one firm now that's kind of stood up to Trump and found a solution, and it's got its wind project going back again. And I suppose that leads on to a question, Matt. I know you're not necessarily representing kind of Microsoft here, but obviously it's an energy intensive firm that has a big interest on making sure that it has a kind of a reliable supply of low carbon energy for the foreseeable future. Is the role of investors increasingly at that kind of policy level as much as the at the corporate level, engaging to ensure that the kind of energy transition maintains its pace and has that and is responsive to the needs of energy users and workers. We know how sensitive the US consumer is to rising gas levels.
Yeah, I mean, yeah, policy is obviously critical. I think for companies like Microsoft, obviously energy is material. Construction of data centers is material as we look at things like the artificial intelligence growth, and trying to decarbonize that as much as possible while wielding a certain level of our influence in the market, I think certainly has benefits to everybody. Like turning on 3 Mile Island, like depending on your opinion on nuclear energy, is going to have benefits to bring clean energy back to the grid for many besides Microsoft. But I think from an investor perspective, what I often see is kind of a myopic view of the social at the intersection of the energy transition, where, and what I mean by that is, just as an example, like taking lithium mining, which is great for sustainable transition and, you know, green energy, horrible for kind of localized environmental impacts. You know, investors kind of look at that as, well, lithium's good because it's going to help these companies store battery. They can take the green energy off the grid, put it into a battery, and then use it and use green energy 100% of the time. But they're missing the horrible environmental impact of the local lithium mining. And they're not doing things like, at least I don't see them doing things like investing in potential new lithium research to try to figure out how to lower that impact, or doing things like adaptation. Adaptation investing is like so low, it's mind-boggling to me. Most companies have been focused, and most investors are focused on mitigation efforts. But there's a real social impact that I think is getting overlooked. And something Bonnie said earlier, like if your value chain is having these impacts, it's going to impact you in some manner. And every company I talk to, every investor I talk to, they're not thinking systemically like that. It's mind-boggling to me.
Mm-hmm. Well, certainly, I think the mining point is a strong one to bring up when we think about the energy transition. I mean, we know full well that you know, there has been a kind of institutional investors have been very focused on the kind of critical mining sector. And I thought I might bring Bonnie Lynn on this kind of question, as I'm fairly sure Canadian by background. Now, obviously, we know that Canada has you know, has a lot of companies that make money from digging stuff out of the ground. So that's so, you know, clearly the kind of just energy transition does have a you know, clear implication for, you know, for jobs in Canada, as well as, you know, other kind of social risks. And I'm wondering how that balance looks from your perspective.
Yeah, I mean, I spent 15 years in the mining sector, 60 countries, 25 years in total, but 15 years of that in the mining sector, specifically for Canadian, London, American, Australian listed companies all over Sub-Saharan Africa, Latin America, Asia, and so on. But we are going to see this play out in Canada now, which we haven't for a long time. So it's been fairly under control, other than some land disputes between First Nation communities and land ownership and tenure. And so now with Mark Carney coming in as Prime Minister, he is pro-resource. We are a resource-based economy. 60% of the world's resources are traded on the TSX or TMX. And we have national instruments with guardrails around environmental, social, and governance. We also have ratified the Modern Slavery Act and the United Nations Declaration of Rights of Indigenous Peoples. And they have their own frameworks as well. So we're going to see this play out. As he is pro-resource, he also believes in the guardrails of ESG. And so this is where it will substantially differentiate from his opponent throughout this most recent political election, whereby all of the resource plans were going north-south to United States. And now Carney will actually build east to west and out the ports to Asia and Europe in new alignments for new customers. So pushing some of those projects forward, but they aren't going to be the same projects as the opponent would have liked. And so because they don't have the jurisdiction and the guardrails on social governance, land tenure, and First Nation partnership that the other projects do. So it will be these projects and not those projects. So there'll be a lot of heat in the next couple of years playing out through Canada as we build those pipelines east to west. But it's going to be very interesting, and there will be no shortage of disruption. When projects start to get built, once they are permitted, the building phase really is where the trucks are blowing by and the dust is in the air, and waterways are contaminated, and people don't understand the physical severity of it until it's in play, and then they change their mind, and things like that happen all the time. And so how political will it get? Who will control that? I really think the First Nation community in Canada, the Indigenous communities in Canada, will control a lot of that now in a way that they have never done in Canada's history before. They have protested and disrupted projects, but they will be owners of these projects going forward. So this is going to be a really substantial change for Canada.
Thanks, Bonnie Glenn. That's a really interesting kind of in-depth insight into the kind of particular issues for Canada and in its different populations. Now I know that time is running away with us already, but I feel it would be slightly remiss of a socially themed panel discussion not to touch on the element of the kind of ESG backlash that's been particularly kind of prevalent this year in terms of the Trump administration's, frankly, war on DEI, if I can put it so sharply. Now, I wanted to ask Bill, partly because I know that you do have a hard stop at the top of the hour, whether whether you're kind of seeing a kind of tug of war almost in terms of the fact that investors are pretty strongly in favor of a lot of the kind of initiatives that are now under threat. Is DEI under terminal threat in the States?
Well, I think. I guess my view on DEI is that it was, in many ways, poorly executed by a lot of companies and half-heartedly so. And I think it gets back to what I said earlier about companies just lacking courage and spine. And by the way, companies that do show courage are going to be rewarded by consumers and by strong brands and by the ability to, lead the markets that they're in. And I'll give you an example of that in a second. But so that's kind of the backdrop. And then I think you get examples of this in both directions pretty much every day. The most recent one, by the way, is Verizon. Large US-based telecom company announced, back in, I think, 2020, came out very, very strongly in CEO messaging in favor of DEI, was very consistent about their support. Now, how real it was, I can't speak to at this point, but what I can tell you is they were also recently trying to Frontier Communications. And basically the Trump administration through the FCC essentially said, drop all of your DEI commitments. And in fact, come out and publicly renounce them and we'll go ahead and approve it. Verizon did so, and a day later, FCC approved the merger with Frontier, or the acquisition, I should say. But in a weird way, the better example, and it's a weird example because it's actually two companies pretty much in the exact same industry, and it happened at pretty much the exact same time, was Target and Costco, both of which occurred. And for those of you not in the US, they're big box retail shops. In Q1 of this year, Target walked away from its DEI commitments, largely under the threats from the Trump administration. Costco came out, and by the way, in walking away from it, they were absolutely pummeled by a consumer backlash, which resulted in low, store traffic, weak sales, that whole thing. Costco came out and did the opposite. They had the exact same pressure. They're in the exact same industry. It was the exact same moment of time. And the CEO and the chairman of the board came out and basically said, listen, America, the fabric of America is based on diversity, and we are not backing away from it. We are leaning even harder into it. And literally all the business that left Target just went over to Costco. They were rewarded by increased foot traffic, increased period over period store sales and increased profits. So I think it really just comes back to, I think companies need to be more honest, and they really need to kind of think about what it is that they're trying to accomplish. It's a strategic issue, right? It shouldn't be like just, greenwashing or green hushing. They need to, every company needs to reconcile their feelings on this. And I think then investors will respond accordingly.
Thanks, Bill. Now, I know, having read Matt's excellent Substack, I promoted my own at the top of the session, so I should promote Matt's, which is I would highly recommend. But I know that you've been focused on this topic, and you would agree with Bill, wouldn't you, that a lot of DEI policies have been poorly executed, and they've really kind of focused on issues in a way that has somewhat left kind of hostages to fortune and haven't really kind of delivered real world benefits to that they were intended to.
Yeah, absolutely. I mean, and I write about this often. What I've come to realize, and it's taken me a while to realize this, is that companies really miss the opportunity to hire people with domain expertise in this area to stand up the programs that Bill's talking about, like these programs that ended up being maybe not as impactful or meaningful to the business as they could be. One of the companies that has done a good job, I think, is Paramount. Paramount did a lot of research into their audiences and found that in the research, audiences wanted to see content that reflected the communities in which they lived. And what they ended up doing was they stood up a program called Content for Change, which end to end in the creative process includes diverse people, diverse perspectives, all sorts of different things. Now, again, though, like Verizon, they're going through a merger and acquisition, which they've been trying to do for the past 2 years. And they have decided to scrub DE&I from their website. But like, if you go out to their website, and I'm out there now, like they're talking about inclusion and impact instead of DE&I. And what they say is celebrating our differences. We believe that to be the best creators and storytellers, our company must reflect the many audiences and communities we serve. And by the way, this was their most material issue that they identified in their materiality matrix a couple of years ago. So of course they're going to still do those things. But I think companies need to take a close look at how they're looking at these programs. If they're looking at these programs and they're saying things like, we don't have enough diversity in our leadership, fix it, that is not going to work. If you look at that same problem and say, how do we fix the systemic promotion problem that exists here? Because clearly there's a problem. That is the approach that they should take. And I don't think companies get it. So again, my recommendation to anybody who's listening, find domain expertise here and really build your programs around it.
Okay, thanks, Matt. I just wanted to come back to you, Paul. Paul, whether you feel that that those kind of concerns expressed by kind of Bill and Matt really kind of reflect how you see the kind of company policies on kind of equity and inclusion, how they've kind of played out so far.
Look, any board has got to be authentic. It cannot change. It can soften its language. It can change its narrative. But if a board, in terms of the Verizon example that Matthew just flagged, if a board changes when the political wind shifts in that way, what does that say about the board and their governance? And whether it's DEI, whether it's ESG, whether it's a just transition, I mean, that would, as an investor, and maybe this is to Bonnie's price, if a board is so inauthentic in terms of the way it deals with risk, that I would maybe look at them as a very interesting arbitrage play as a company, So that fundamentally asks questions of the governance, the board, the setup. And that's so fundamental to what investors should be looking at. I'm not sure if I said it on this, but ESG should have been GES. It was governance, environmental, social. And there were two reasons we changed it. One was my children went to the Geneva English School and I couldn't have the same acronym. This was back in, I joke partly, right? But look, governance, you get that wrong, you'll never fix anything environmental or social. So, the Verizon thing is just phenomenal, right? In terms of an example. Yeah. So if the political weather vane shifts, which it always does, and okay, we've had an extreme shift at the moment, and a board does not stand up to a fundamental value, even if it softens narrative, softens language, that is a huge question mark over the board and everyone on it.
Okay, thank you, Paul.
I think we kind of have to wrap up about that. Yeah, it's pretty much up now, I'm afraid. Yes, sorry.
Well, I just kind of just give my 10 seconds to say thanks immensely to kind of Paul and Matt and Bonnie Lynn and to Bill, who've all been fantastic. We could happily talk for at least another hour, but thanks very much.
Well, we can get together again and we'll do it.
Thank you.
We'll do it.
Thank you, Chris. Good. Bonnie, good to share. Matthew, good to meet you.
Thank you, everybody.
Thank you, everyone.
Thank you.
Bye.
Bye-bye. So Lizzie is going to have a brief chat with Paul now. Where are you? There you are. I am so sorry to say this, but you're going to have to make it a quick chat. But over to you.
No problem. All right. A quick intermezzo, Paul.
Hi. Let's make it a double espresso, okay?
Exactly. And I wanted to touch anyway upon a subject that you were just actually referring to, because it's very interesting to hear your point of view on that. Because the term ESG, as you said, it was actually a different term or a different order of terms, but the S was placed in the middle for a reason, as I understand it, because it was never just about policies. It really also was, as you mentioned here today, about bringing that human side back into business. So can you tell us why the social element is at the heart of ESG, and also how it connects to governance as our moral compass?
Yeah, and look, I'll sort of put my former UN hat on in that. And you mustn't forget where ESG came from. It did come from the UN, right? And Michael sort of slightly misrepresented me before when he said that we put S in the middle to stop it falling off the end. It was to protect it. And it was to protect it as the most important part of the ESG, tripartite arrangement, right? And that really stems from what we were looking to do in the UN was speak to mainstream capital and deep pools of capital, right? And change their culture. So it's the asset owners, the pension funds, the sovereign wealth funds. And for us, you cannot disconnect these issues on a planet where the nature of risk is changing. All our risk sets from the past 2 centuries, past 50 years are changing, right? You can't look in the rearview mirror. And the social piece in terms of, the population is 8.9 billion now, 10 billion by the end of the century. Africa will be the only continent growing after 2050. It's 1.4 billion now, will be 4 billion, right? The social piece, inequality, and taking down from systemic risks to workers' rights, the very brutal end of neoliberal capitalism, the 0-hour contracts, the ability just to take workers and dismiss them. It's part of capitalism, but it's not regenerative capitalism. So to come back to your point, it's not about S falling off the end. Everything should start with S. It's the most difficult for investors. It's the most difficult for companies. It's the most difficult for everybody to get right. And again, the point in terms of the S is that the S apps, the 3 issues, it's never E and S and G, it's ESG, it's a block. My metaphor now is a Rubik's Cube, right? And it doesn't matter how you shift it, what the letters are, right? It's all interconnected. And we know that at a systemic level, we know it at a corporate level. Bad governance will slash retention, get your just transition wrong, and your coal mining community in Poland is, on the dole, not making solar panels. I'm being simplifying, but S absolutely critical. Lizzie, back to you.
No, that's great. It's all I love listening to you, because I can really resonate with what you're saying. And one of the things that I run into when I speak with companies and when I'm in leadership teams is to create that holistic worldview in how you address problems. And it's quite tricky because indeed everything is connected. So where do you start? How do you do this as a leadership team? Do you have any advice?
Yeah, look, in terms of whether it's investors, it's the board. It goes back to ESG was about shifting culture. It wasn't about drop-down menus. And that's why it wasn't particularly defined. And it's different for all the different regions, right? It's about culture. In terms of the culture of your board, or the cultural bridge between your key investors and the board and the entity, it's about shaping the way a company is. And that's why culture is so important. If you do not align to a reasonable degree with flexibility corporate values from the top down throughout every facet of the company. And it's very, very hard to do, but it is that culture will, the old thing is culture eats strategy for breakfast, right? So for us, planting the ESG side inside asset owners, the investment chain, was to send signals to the corporates and the investee corporates that, ask that question. In a changing planet where the nature of risk is changing and mobilizing and converging. So at my company, the Blended Capital Group, we call it complex converging systemic risk. Once you begin to understand that, you begin to unlock new value in investment opportunities and product opportunities. But the only thing that allows you to help that is having a culture which is open, diverse, understanding that the nature of risk is completely changing, and we have to adjust to that. So there are big questions, but they can be delivered in small actions. And let me finish with this point. A company board, whether public or private, has got to have a narrative that it can defend in difficult political times. And we always say, actually, capitalism is very simple, and ESG applies to that. Is it a risk, yes or no? If no, move on. Is it a risk, yes or no? If it is, and you don't deal with it, what does that mean for your fiduciary duty? So it's a culture that can be open to dealing with new types of risk, to understand where the new opportunities are. Sorry, I sound like a stuck record, but Lizzie, that's where it comes.
I want to hear more, but I think it's time.
Thank you very much, guys. We've got to wind up, but thank you.
No worries.
Lizzie, good to meet you. Let's catch up sometime.
Definitely.
Thank you for your time today, Lizzie.
Right.
And Paul, we do have a session later on today. If you want to join us, if you're around, if you can, that'd be great. But
thanks, Michael. Do you want me back for closing?
Well, that's what I was thinking. Yeah, beyond the ESG. UK time, it's 20 to 5.
All right, brilliant. I'll be on.
25 to 5.
Lizzie, thanks for the double espresso. Ciao, ciao.
Thank you very much. Thank you. Right, now we're going to I need to get rid of
Paul.
And Bonnie should be here somewhere. She's gone. Oh, there she is. And there's Sneha. Right. Okay. So guys, we're going to get straight into it because time is short. And I would ask you your first question, which is, what's the future of ESG investing? Is there a future for ESG investing? Last year, you've already suggested that you think it's impact investing and sustainability investing. But yeah, can we just do a bit of crystal ball gazing for a moment? And in order that you're on my screen, last year, I hope I've said that correctly. Can you go first?
Yeah, absolutely. So what's the future of ESG investing? I think now's a good time to take stock of what we want to achieve with ESG investing and what the issues have been, because we have seen a certain level of backlash. It has been weaponized and used as a political tool. And I think instead of just like finding that depressing and worrying about the state of humanity, we can also try and understand where that has come from. Because I think there is the perception that ESG is just something that the liberal elite have come up with, and it's not attracting the mainstream popular voters a lot of the time. So I think we have an opportunity to make ESG more inclusive, to really engage with the people whose money we're ultimately looking after a lot of the time. I work in the pension space, so it's ordinary people's money who we're investing on behalf of. But also to recognize the scale of the impact that we can have as an investment industry. So that's why I think the future of the ESG investing, and this is me taking a very optimistic view, is one that it becomes much more accepted in a mainstream way, whether we use the language of ESG or not. I don't think we need jargon and acronyms all the time. But also that we recognize the kind of scale of positive impact we can have as an industry and lean into that. And that's where we perhaps move along the spectrum of investing away from just ESG investing, which I think is just investing properly. That's just doing your risk management properly, and go towards sustainable investing and impact investing. So that's my optimistic vision for the future.
Okay, but thank you for that. I'm sorry, Sunny, would you mind putting your microphone on mute? I think there's a little bit of background noise coming. We think it's you, but it might not be. Cecilia, the future of ESG investing, if indeed there is a future.
I do think there is a future, but I think we are actually living through a very interesting time where we have a redefinition of what we thought ESG investing was. We are, from a political standpoint, we have a lot of different frameworks and a reworking of, what is ESG? How do we report on this? How do we work on it? How do we use it in a due diligence process? There is a global change at the moment, and we see, of course, an emerging IASB framework, but developments in various regions of the world. I mean, from the EU perspective, we will have an opening of the sustainable finance regulation, and that again will probably change some of the definitions with regards to ESG, what constitutes an ESG investing approach. As well as taxonomy. I think we will see a clear link between the taxonomy framework and the ESG and sustainable finance investment space. So that could include, like I said, other industries such as defense industry, given the geopolitical changes we see, as well as, from the pension fund side, there are certain industries where they cannot invest in or where it's more difficult for that kind of institutional investors. And I'm very sure we will see a reworking and a redefinition of some of those terms as well. So I would say, yes, there's clear future, but this is very much an evolving space where we'll probably have better definitions as well.
All right, thank you. And something's happening with Sneha at the moment. So Bonnie, I think there's going to be a slight disagreement between you and Garcia. So
a difference of opinion, yes, for sure. Listen,
it would be a boring panel otherwise, wouldn't it?
Yeah, that's right. Listen, ESG isn't an investment strategy. What ESG is an integration of risk criteria. So there's people use the context ESG investing all the time, but really what they're talking about is sustainability or impact. But ESG is a diagnostic tool. It's a list of criteria that you're vetting against, and it really isn't a negative screen such as ethical investment strategy as well. So it doesn't screen out defense and it doesn't screen out tobacco. It tells you whether or not the laborers are paid equitably. It's a yes or no context. So it really is that governance management system within the context and how well they're managing people in society, whether they are employees or community or consumers. And it really is a checklist. I mean, I've been working with the ESG framework since 2009. I know Paul coined it in 2004. The S was a little light, so we've beefed it up to about 1,200 indicators, which is substantial. But it actually would mirror the double materiality approach in Europe, which really is the preface for the regulations trying to be pushed across through SFDR and CSRD, Triple D, and so on, to look at scope 3, not only emissions, but it's inclusive of exploited labor, working conditions, and so on. So it is working its way in parallel to societal, the intent for societal change, which would be an impact strategy. So we would say, 70% of garment workers are females and they are the most exploited. We want to change that number over a period of time. That's an impact strategy. But the diagnostic tool that tells you this company has this many workers and these are the conditions, that is an ESG diagnostic tool.
Okay, do you want to come back on that last year before we move on, or are you happy for us to move on?
I think I agree with that. I agree with what ESG investing is as you described it. I guess what I'd like to see is us not just doing a diagnosis, but adding that impact overlay that you described.
Okay.
Yeah, and also want to just add that, agreed. The problem is the regulatory and policy framework, it doesn't really follow this concept at the moment. Yeah. So we need to change this.
Yeah, indeed. Okay, so they always say that Britain and America are two countries separated by a common language, and I wonder whether the US and Europe are two continents separated by a completely different understanding of what ESG is, and whether or not the two things are completely different now. I mean, is there something in that? Is the US mindset very different from the European mindset? And I think I've said enough.
I can talk about what I'm seeing amongst European investors, maybe, and I know you see the US investors more. Definitely, I think there are quite different mindsets, and I'm sure there are investors in the US that are still passionate about ESG and sustainability. But I think in the UK and in Europe, it's very clear that these are financially material risks. It's part of their duty to care about sustainability. Climate risk is one of the biggest financial challenges in the long term that will affect the ultimate beneficiaries. And actually, on the back of many US firms rolling back on what they're doing with ESG and climate, some European investors have chosen to move their money away from them. We saw the Asset Owner Climate Stewardship Statement. We saw the People's Pension, which is a £50 billion DC Master Trust, move its money away because of that. And from the kind of US managers I'm speaking to, I'm seeing a lot actually try to separate their European business from their US business because they know that their European clients do care about this. And I think in the US, it's more challenging. But I'm not really speaking to US investors, so I'd be interested to hear what you're hearing from them.
Okay. Bonnie, do you want to have a go? Do you want to come in on that one?
I mean, I'm all over the map.
Close neighbour, you might know a bit more.
Yeah. Listen, they are a stark difference, but not from. There's a massive consortium of impact investors in the US who are not ESG players. They are pure, philanthropy, mission, values-based investors. They don't understand the context of systems management and diagnostics and ESG. So they're not in that vein. So they still wield trillions of dollars. I mean, in the United States, in the impact vein, regardless of DEI context, regardless of regulation. And then in Europe, we see the omnibus and the pushback against CSRD and so on. Sorry, Sneh got, yeah. Oh, no. Sorry. But I will tell you, I'm meeting with some of the world's largest global players, but again, their P&Ls are separated by the ocean. So here in Europe, they're wanting to meet with me about ESG integration. And these are some of the largest players in the world, but their US counterparts are not inviting me to the table, but the European counterparts are, which is very interesting. So they are doing something about ESG, not just impact.
Okay. So Sneha, we were talking about the difference between European and US attitudes to ESG, such as sustainability investing, or indeed, for that matter, the broader world. I mean, I think you could describe yourself as the Indian representative here. Are you seeing a difference? Is there a different mindset, do you think? Is the US mindset different from other places?
And in terms of ESG, I'd say it has grown up. So the backlash, if we talk about it, especially in the US, I think that has stripped away the fluff and also forced investors to focus on substance. So it's also like ESG has moved from feel good to show me the data, and investors are asking, if this is financially material or is this risk adjusted. So I think most importantly, is ESG also standing up to the scrutiny? So I think it's a necessary reset, talking about it from different perspectives. And ESG is also evolving into something quite leaner, but far more credible in terms of data transparency. And I think the real opportunity also lies in this transition where it's not just clean tech, but also in financing the decarbonization of high emitting sectors. But this is also quite regional. I think somebody was mentioning about omnibus and the regulations. So there's a big opportunity which lies in here in terms of the frameworks and the regulatory requirements.
Okay, thank you. And Cecilia, do you have anything to add on this topic?
Yeah, I think, we see a stark difference specifically after the election, of course, between the EU and the US, specifically when it comes to ESG. although it's worth to mention that the definition of ESG and the current kind of landmark legislations, such as the Due Diligence Directive and the CSRD, is now undergoing fundamental change. They're going through the political process at the moment. It's been discussed in European Parliament. There are member states that have clearly come out to say that they would like to scrap all the already agreed due diligence requirements. So we do see a kind of a change in Europe. That doesn't mean they're going to backslide completely. It means that they need to rework some of these definitions and the regulatory frameworks to kind of fit with the new geopolitical reality. So that's basically what is happening. What I want to say is like the big change, I would say, is that Europe has, well, so far, we'll see about that, but Europe takes kind of a double materiality. They look at it from a double materiality perspective, while both the UK and the US see it from a single materiality perspective. I think that's kind of the core point here. And I don't think that will change regardless if we have changes in the European regulatory framework. There is a different view on this, where we look at the companies, you know, how these affect the company, but also how the company affect the environment. And it's more of a...
Interesting. So you're saying UK and US is more of a focus on single materiality.
Absolutely.
And does that fit in with this idea that the American culture is very individualistic, European is more cooperative, and the UK somewhere in the middle? Does that fit in with what you just said?
It's probably more, I mean, it's more complex than that, but it's, you know, it's a different cultural, political environment with other traditions. And of course, we have already a fairly substantial, let's say, environmental sustainability, circular economy legislation, chemical legislation, very, very strict legislation across the board. So, you know, when you bring all that together, for a lot of companies operating on the European market, they anyway have to do a lot of these activities. And if we go into the space of reporting, that's also completely different. I mean, now, of course, we're going to have mandatory reporting, but, you know, companies of various sizes have already reported in Europe that it was mandatory to do an ESG report, while in the US that's not the case. I mean, if you're a private company, sometimes you don't even have to do a financial report. So there's completely different context here, and we have to understand that, I think, from many perspectives, including one that could be kind of a more, let's say, Anglo-Saxon way of looking at things from a more individualistic perspective. But I think it's much broader than that, and it's also kind of habit. And yeah, so
okay. So we've only got 2.5 minutes to go, so we've got 30 seconds each. I don't know what you think about this, but there's a saying that a Lord Rothschild, a long dead Lord Rothschild, someone said to him, he said to somebody once, the time to buy is when there's blood on the street. And it was during a French Revolution, not the French Revolution, a French Revolution. And his trusty servant said, yes, but there's blood on the street. And he said, well, the time to buy is when there's blood on the street, even if some of the blood is your own. And it's a sort of like an investing saying that I quite like. And I've always said that the best time to buy and invest in an internet company was when the sentiment against the internet was so low. So high, sentiment against was so high. I'm going to mix up my double negatives there. Is now a good time? I mean, because of the so-called backlash, is now a good time to be looking at. Let's talk about ESG. Let's just talk about sustainability in general, investing. I'm so sorry, you've only got 30 seconds each. Who wants to go first?
I can go quickly. I mean, yeah, I guess there's well, on the one hand, when we look at the UK, there's a huge investment opportunity for the UK to become, a hub for energy transition, for example, because in many ways, UK investors now feel like the US is making themselves increasingly more uninvestable because of their rollbacks. So from that perspective, there are opportunities for other markets to step up. But yeah, also just from a supply and demand perspective, if you've got a bunch of asset owners that are now saying they don't want to buy sustainable assets that are going to fund the energy transition, for example, there probably are opportunities there. But we also need to acknowledge that what is attractive from a financial perspective does depend on the political environment around us. And so we should, also work to influence that. Hopefully that was 30 seconds.
Possibly, I wasn't timing it. Cecilia, over to you.
I do think so, but timing is everything, and it's also important to predict where there are certain sectors that we already know will receive a lot of new financing. I attended a Invest EU conference hosted by the European Commission here last week, and we're going to see a lot of more money being channeled via the European Investment Bank into strategic sectors, exactly for political reasons, but for competitive reasons as well. So you have to kind of pick and choose some of the winners. And we see sectors such as, biotech, defense, critical raw materials. I mean, sectors like that, which of course, ensure a sustainable profile. Specifically, if we have a redefinition of taxonomy, yes, that is very well worth investing in.
Okay, and Sneha, I'll give you the last word, Bonnie.
Well, I think absolutely. It's more of a reset moment, and Europe has the upper hand. So this entire backlash, this is also helping weed out greenwashing, and it is shifting the focus a lot to integrity and delivery. Europe, at the same time, also now has the chance to shape global ESG norms through credible taxonomies or also stronger disclosure regimes and better integration of science-based targets. So I think it's a bigger opportunity like this. This might see an integration or creation of ESG 2.0, if I might call it like that. Less hype, more discipline, and also a new baseline for how sustainable capital should also behave worldwide. And also linking this to your prior question, where between Europe and US, I think Europe is also very regulation-led. For example, SFDR or CSRD and the CSDDD, all pushing ESG from voluntary to mandatory. And in the US, where ESG is under attack in some states, where even like talking about pension funds, they are even being barred from using ESG criteria. So this is also in terms of opportunity. I think global investors, they now need a region-specific playbook, and what counts as ESG compliant might be at one state might be controversial in another state or country. So I think it's no longer possible to also take a one-size-fits-all approach, and it really depends on how we are maneuvering the different regulations and different taxonomies to just play it out in terms of European investing or ESG investing.
Okay, and Bonnie, can you do it in 30 seconds?
I'll try. So the question was sustainability. Do we do it now? Like, is it time? And I would say yes, absolutely. So coming from Canada, Europe's always 10 years ahead of us. The US is always 3 to 5 years ahead of us. And then Canada's like the last to jump on board after they've watched everybody else's trial and errors and successes. And then we decide what to do and we white label it. I think that's going to change under Mark Carney. I think that he will align with the EU and fast track, and actually the US will be left behind by not jumping on board and aligning. I think Asia's already way ahead of the track and aligning with EU as well. They are the leaders in this space. And finally, I'll just leave with, we don't need to wait for anybody. Investors who are aligned with this mindset, a value set of what they do and don't want to invest and don't need to wait for policies and taxonomies. They actually like impact investing.
No, that's you've said something similar to that on LinkedIn before, I think, and I think that's a good point. Okay, well, look, thank you very much, everybody. Thank you. We're going to have to pretty much close this straight away, I'm afraid, but thank you. And I'm trying to find something on my computer at the moment. It seems to have vanished. Oh, here it is. So thank you very much, guys, and I'll speak to you all soon. Thank you.
Ciao. Thank you.